You are locked in to the Cash Flow Show with Dave and Nate, the best place to navigate how to achieve capital appreciation with commercial acquisitions. Here's your hosts, Dave Seymour and Nathan Amaral.
So you don't know what the picture looks like. That's okay. I get it.
Okay. No, there was...
Are we live?
No, we're live now, but there was like a delay, and I'm like, what's going on? And then, the picture... No, the picture looks fine, actually.
Is that better? My Lord, man. How long have we been doing this and we still haven't figured it out?
Well, you know what it is? Have you noticed, like, every week we change our studio a little bit? I mean, thank God we change our clothes. But
yeah, where are you now? Are you
I'm in my new studio office.
Studio office.
I'm in my new office.
You go with the blurry background. Blur your background. I want to see the pictures on the wall. What do you got?
Oh, you just want... Is it blurry? Really?
What your background is, yeah. That's
hold on.
like
let's try that. Hey, you just want to see this picture right here. You just want to see... Where is it? That picture right there.
What is it? I can't see. Is it me?
It's me and you, yeah.
Oh, really? Yeah. Back in the day. When we were traveling the world, changing people's lives.
One at a time.
Educational environments at a time. Dun, dun, dun.
Oh, goodness.
Did I ever tell you about the time I had so it was like a demo reel they used to play before I go teach somewhere, right? And it was like, Dave Seymour, and he did this and he did that, and he's been an investor his whole career.
Right.
But what we did was I found a guy who sounded just like Morgan Freeman.
Yeah.
You know that story? And you could get a Morgan Freeman sound-alike for like $150. It's crazy, dude. And every time I go out on stage, it would be like, please put your hands together for Dave Seymour. But it was Morgan Freeman.
Oh, man. But when you have Morgan Freeman doing a voiceover, it's just quality right there.
It's business.
It's
you know
business
what I mean?
right there.
It's the business.
It's like people
there.
have to take you seriously now.
Yeah. Look, if Morgan Freeman says I'm all that in a bag of chips, then I must be all that in a bag of chips. With a side of something or other. I don't know what it is, but yeah, I'll have to find it and I'll have you play it one week. Just
you should do that.
Yeah.
That's great.
Yeah, it's fun. It's a fun little piece. Anyway, how are you, brother? You well?
I'm doing good. Yeah. How was your week?
I got to be very, very direct.
I'll be direct too. Go ahead. You first.
It's flying by at 100 miles an hour.
Really?
The political landscape is as crazy today as it was a week ago, as crazy it's going to be a week from now. I was just in town this morning and I shot a TV commercial.
Okay.
Here we have a cable station called NECN, or the New England Cable News. They're part of CBS.
Okay.
And we shot a 30-second TV commercial, hence my nice clean white shirt.
I know. You're like
to my sense again,
Got your
dude.
hair done and you're all looking sharp.
You
you got your smart glasses.
Smart glasses on.
You're looking so smart there, buddy.
I'm a fat smeller. I mean, a smart fella. I don't know what I am. That's what, your cousin from Boston. Have you seen those commercials?
What's what? Oh, have you seen You're So Smart?
In nowhere. Yeah? Have you seen them?
No.
What?
What are you talking about? What are you talking about?
Where are you?
I'm in Azores.
That's right. Have you seen the Sam Adams commercials? Have you seen it? Do they play out there?
Is it the one? No, they're not going to play it out there. But is it the one? No. I haven't seen that one, but I have one for you.
So the commercial is your cousin from Boston.
Yeah.
And this guy, right? He's at a wedding.
Yeah.
And he says, Sam Adams lager is like love. It's deep. It's rich. And it doesn't last very, very long. Let's all be honest. Betty, you're smoking. You're a smoker. I was like, anyway, I was in Boston. I was shooting a commercial. And, part of the dialogue for the commercial now is to really begin to, I don't want to use the word tap into the fear of, but really align what we do, with the fear that's in the marketplace. And I'm talking to investors, and I don't know if you're getting it out there because it's global. You probably are. But I'm getting from investors, they're so scared, man. Like, what is November 3rd?
Right.
What is
That's the first one. That's the first one. Yeah.
You know, the tax implications of a democratic, government, right or wrong, left or right. But the average investor is sitting there on a fear factor.
Yeah.
Whereas us in commercial real estate, I mean, for us, we'll talk about it, I'm sure, today, but I don't care who's in there, really. At the end of the day, when it comes to my business and serving my investors, you know, it sounds so corny. I'm in a win-win situation. When you invest with Freedom Venture Investments, you know.
No, it's got to be in the Morgan Freeman voice.
Right. Just ask my buddy Morgan Freeman. So it's been a crazy week. I've been dealing with a lot of fear, a lot of insecurity, a lot of doubt, watching a lot of capital move. I had 2 calls this week with international hedge and retirement folks. Those are always interesting conversations. So, it's busy, man. Busy.
Yeah.
I think I saw my wife and kids at some point.
Oh, geez, yeah.
You want to hear a funny story?
I do. Go.
This is funny. You're going to hear it. Ready?
Yeah.
Do you want to do the first?
I should do it. I should. I'll do it.
Do it. All right. Okay.
I should be able to like roll out like some music. No, okay. But welcome everybody to the Cash Flow Show. We are your hosts, Dave Seymour and Nathan Amaral. And this is your chance to let us know and introduce yourself into the comments and say hello to you. If you're new here, post new in the comments below. Or if you've been watching us for a decade, you can post that in as well. Say hello to us in the comments and we'll say hello back. At least we'll do that.
But if you know Morgan Freeman, tell him Big D and Nate Dogg says hi. All right?
All right. Go ahead. Tell us your story.
Look, the week was chaotic. It's tough. You know, we talk about entrepreneurship, right?
Yeah.
And we transition out of a 40-hour a week job into entrepreneurship so that we can work 80 hours a week.
So true.
Right? But
it's so true.
I think I've been kind of like passing my wife and kids, you know, in the hallway kind of thing. Hi, how are you? Hey, I'm your father.
I'm
nice
your
to see you. But Ben, it's funny, man. It's Christmas is around the corner. It's not around the corner, but it's always around the corner for these kids. So he leaves me an envelope on my desk at home, right? Yeah. And it says on the front of the envelope, it says, David Seymour, CEO of Freedom Venture Investments, from Bennett Seymour, from CEO of Tricorp or something, like he's created some corporation, Tricorp. And then when you read the back of the envelope, it says, do not open if you are grumpy or in a bad mood. So it says on the back of the envelope. So I open it up, and it's a 10-point Christmas list. Okay. Oh, dang. So now, although I'm distracted, now he's dialed me right in to being present with where this little 8-year-old is. And a couple of things on the list. Really, there's only one thing that kind of made me laugh my rear end off. Was the number 2 request for Christmas is that his brother Jeff not be around for a whole day. Oh. He doesn't want his brother in his life for just one day.
Oh my gosh.
It's
like, just done. Just done.
Jeff free day. And I'm like, yeah, I probably could figure that one out before anything else.
Yeah.
So, yeah, the week was nuts. Distracted. Business is firing on all cylinders. It's chaotic. What about you? Enough about me. What about you, Nathan? How was your week?
My week was chaotic. I can't disclose too much, but interesting enough, some legal issues have come up here, and it's going to be interesting. I don't want to disclose too much right now because it's you know how those lawsuits go. You want to make sure you have everything lined up, but it's very interesting. And one thing I could and I've said this for so many years. What's really important in real estate is that you have good advisors and real estate attorneys. I always like to say have a real estate attorney or a team you can trust that you can rely on. So yesterday I had a great meeting with one of my real estate lawyers here, and I mean, when people are smarter than you, it just goes back to something that we know that's so true. Have people in your life that are smarter than you, that know what to do and how to do it, and you trust them, and then to move forward. And of course, you make the final decision. But man, that's what it's really about: surrounding yourself with good people that you can trust and that are smarter than you. because they will guide you and lead you through interesting situations. But other than that, the week's been good. My folks are in town. They came. They flew over. Yeah, that's been the best part of the week. Yeah, that's been the best part of the week.
By the way, I was right. Ronaldo did get COVID.
Oh, shit.
Right? So let your father know. Listen to me. I did some research on it. Ronaldo got COVID. Watch this. And the value of the club that he plays actually dipped like 20% because your number one star got the COVID. He was only out for a couple of days or a week or whatever.
Oh my gosh.
It dipped. Like the investors went, what? Oh my God. Ronaldo's got COVID. Dum, dum, dum.
Oh no.
Yeah.
That's horrible.
So just, you and your father, me and your father should have a little conversation, talk soccer, see what's going on.
I know.
See what's going on. Did he get that good bread, that sweet bread?
Did he bring? No, actually, no. It's interesting enough. Even though I grew up around it, I don't really eat it that much. I do eat what those they're called bolos levidos in English, but they're called bougelivres in Portuguese. So I do eat those here.
Whoa! They're called what in Portuguese?
Bolos.
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 You gotta roll the R's and the L, so it's bulls, bull, umbul,
forget it.
The best, easiest way to say it is bolos levidos. How about that?
Bollocks.
Bollocks.
Diabolical. Diabolical. That's what that is. What are you talking about? Bolos. You know a word I found this week I haven't said in years?
What's that?
Watch this. Try this one. Blancmange.
Blancmange.
Do you know what blancmange is?
No idea. Blancmange.
It's like pudding. Pudding. It's the French word for pudding. Blancmange.
Really? Blancmange.
Yeah. What the hell are we talking about?
It is blancmange. It's a pudding. Wow.
Blancmange.
Blancmange.
You were kids.
And actually, I've eaten this before, but I didn't know. And it's sweet, and it's kind of like it's not Jello, but it falls in the line of like custards.
Yeah, like a custard.
Yeah, like a custard.
Yeah, like rhubarb and custard.
Rhubarb.
That kind of stuff.
Yeah, I like that kind of stuff.
Oh, yummy. All right. So, your father's over. How's your mom?
They're good. They actually had quite a hit of jet lag, but you want to know something crazy? COVID experience and probably poor airline management. They drove up to Boston, right, on Sunday. They drive up there. They get to the counter, and the airline says, "Oh, your flight's not today. It's tomorrow." And on the ticket, it says the day they're flying, which was that Sunday. Yeah. So horrible experience, with the airline. That particular airline is just a tragedy. But anyway, they made it over here the next day, and they're just a little bit of jet lag, nothing too great. But just had lunch with my mom, which is cool, and we're just catching up and talking a little about business, a little about rentals and kids and all that good stuff. Yeah, it's good. It's good time.
All right, so see. Let's do this. Seeing as we're talking about rentals, I want your father to see this because I think he should be investing with Freedom Venture Investments. All right?
All right.
So just make sure you pass this on to Dad.
I'll pass this along.
See that segue?
Dad, look at this. Yeah. We're jumping right into the deal of the week.
So, this is deal of the week. Yeah, this is Walter has put this through underwriting. Yeah. Has walked the asset. We love this one. It's absolutely bread and butter for us. It fits all of the buy box criteria. So a nice little 32 unit. We're lining this one up to come into the fund. It's in Sarasota, Bradenton area. Bradenton's a nice secondary market that we're doing a lot of business in right now. We're doing a lot of shopping in that area anyway. So it's close to some nice shopping and dining. 10-minute drive from the larger MSA of Sarasota. What's nice is it's got premium beaches all within a short distance to this facility. Okay. So we like that. It offers, quality of life and lifestyle to the tenant base. So the details on the property consist of 32 garden-style apartments. Mm-hmm. So that's 4 buildings and an additional building, and this is important, Nate, that houses a small office and community center. So we're looking now for facilities that can almost double up as that home office. What are you laughing for?
No, I'm just laughing because this is a really great market. And I'm laughing because I'm actually, you know how I've been saying the past few weeks that I'm relocating? I'm actually relocating to this area.
Oh, good. Then
Yeah.
Then
Yeah, that
come
I
see
know.
it.
This is a great, yeah,
Come see
I
some of
can't wait
the
to come see it. Yeah, exactly.
Yeah, yeah. I'm going to be down in Tampa in a couple of weeks. So,
Oh, wait.
I'll
You got to send me we'll talk about the dates. Yeah, we got to make that happen.
Yeah, yeah, I'll be in Tampa. We're doing a luncheon presentation in Tampa. Kevin Harrington's coming over, so it'll be a good time.
Yeah.
But anyway, Smiley boy, where are we?
Sorry.
No, all right. So what's cool about this one is we're beginning to identify these properties that have a dual feature, if you will. COVID, it's probably not going away for a while. We're still going to be living in that new normal. So to be able to supply some office space on site to the tenants is a big upside for us. What's also nice about this particular one, as you can see there, Nate, it's 8.24 acres. So it's a large property.
That's huge.
Right, large property. So there's a lot of walking trails and some waterfront stuff like that.
Yeah.
Creating again that nice community feel for this thing. The community was completed in 2007, so we don't have a ton of deferred maintenance. In 2007, it also went through a structural upgrade in 17. That included HVAC replacement, re-roof, and again, everything's been brought up to hurricane code. So those are the big ticket numbers, Nate. That's the stuff that can make or break a deal. So when we find a deal that's already ticked that box, puts us in a strong position. So repositioning, how do we make it more value? The community was originally created to provide workforce housing. Well, the demographic in this particular area has changed. It's off of workforce, and it's more around quality of life in this particular area. So it's been developed over the past decade, and the quality of the surrounding properties is dramatically improved. So this is an important thing for folks who want to learn this business and some of the nuances in it. This is that worst property, best neighborhood scenario. Okay, this is probably a B- property purely because of interior finishes. So now we take a B- and we upgrade it to a B. And because we're now a B, we parallel with the properties around us. Now we get that rental increase that we have going forward. So at this time, the first and best use of this community will require a shift from workforce housing to mid-range apartment community. Like I said, elevating the standard. It's better aligned with the surrounding area. So the project, we're going to buy this one for $2.6 million. Our capex, or additional capital into the deal, is $176,000, which will be invested into improvements. Now, the new market lease rate for the improved units will increase each unit by about $150, and we're not going to affect cash flow on this, because what we're going to do is we're going to wait for a lease turnover. That's when we'll do the repairs. We can get in and out of one unit probably within 3 to 4 days. So that just is speed of execution right there. The current manager is charging a massive premium to this owner. So the management fees are way out of line. Walter's almost like a
forensic accountant.
Forensic.
Yeah.
Word, man. He's almost like a forensic accountant when he underwrites. The team that he puts on these things really knows where the ratios need to be. So he's generating annual savings year one of $32,000. So rent increases plus a reduction in expenses. That's what makes this such a sweet little deal. So the savings will directly contribute to cash flow, as well as increase in the long-term value of the project when we liquidate the fund 6 years out. That gives our investors a huge upside pop on the final year. So the numbers when they flesh out in underwriting, cash on cash year one targeted at 12.84, so just shy of 13%. Keeping the momentum of this asset, raising rents on a yearly basis, up to the 5th year will give us 15.62% targeted. Now, the IRR, the internal rate of return, somebody was asking me about this this week. And I did quite a little bit of research, Nate, to find out what the definition of IRR is. Like, we use that term consistently.
Yeah.
And I think for simplicity reasons, unless you've got a different way of describing it, Nate, I always say to my investors, the IRR is the return that you expect to get on the value of your money working over a longer period of time.
Yeah.
Okay? That's really what it turns out to be, because when you take all of the cash flow and the equity at time of sale or dissolution of the asset, it blends out to be a 23.3 targeted return.
Yeah.
And then the equity multiple, the 2.14 on this, an investor puts in $1, and at the end of the investment, they get their $1 back, and in this example, they get an additional $1.14. So you're more than doubling your money is the targeted return on this asset over a 5-6 year period of time. So, it's a great deal. It's got great facilities. It's got great upside potential.
Right.
Our property management team will get in there and do what they do and turn that bad boy around. So we're excited about that one. What do you think? It's a good deal, right, Nate?
I like the deal. I've noticed, and this I think this is probably true on mostly all your deals when it comes to equity multiples, is that they're all like doubling the money, right? So it's typically at least. So they're all over 2. The other thing is when it comes to location, and even one of our comments here from Mechanic Taft, he is saying he's moving back to that area in the spring because he's lived there for 12 years and he built many monster homes there for many famous people. This is definitely a great area. It's not this is not a C, D class area. It's a good market. It's a booming market, and anybody who invests here is you're making a smart decision. Let's put it that way. One question that I know that has come up, actually, it came up last week, but I forgot to mention it, is when we talk about cash on cash return, right? So you have a 12.84% here, okay? So how would that work for someone in year 2, year 3? Obviously, those numbers are going up. Do they get paid out quarterly, yearly?
Yeah.
How does that impact them?
Yeah. So look, there's 2 ways to pay an investor. You can do monthly distributions, or you can do quarterly distributions. Okay. Now we choose to do quarterly distributions because the amount of expenditure that it takes to work out monthly distributions is pretty high. So if we only have to do all of that accounting 4 times a year, that savings is obviously then passed on to our investors. And that was a conscious decision we made earlier on. So structure-wise or understanding-wise, whatever the amount of capital that an investor puts into the fund, well, they then own shares of the management company. And by association, they now own the amount of shares within the company and therefore the assets that the company owns, the management company owns. So it's all prorated depending on the amount of capital that they invest. Now, as we do a better job with each of the assets during the course of the fund being in action, that's what raises their cash on cash targeted returns. Q1, Q2, Q3, Q4. We might get a little dip, but then we'll be able to bring it back up. I think what's important to understand is this, and I kind of breeze over it a lot of times, Nathan, is the fact that because they own shares in the company that owns multiple commercial real estate assets, multifamily, they get the diversification of all of these assets.
Right.
Because if we think about, you and I grew up in the world of syndication, right? One group of investors on one property. And if something goes sideways on one property, all those investors are going down with that ship. So we like to do it with multiple assets.
And I'm going to describe that in a different way for people who maybe have never done this before. If you've ever listened to a financial advisor who invests in the stock market, the difference between investing in a stock and a mutual fund is basically this. You have a stock, which would be just one particular property, and if that property doesn't go well, then it goes south. That particular stock, that particular house. However, in a mutual fund, if something is, 2 or 3 companies are not doing so well, then the other companies can sustain itself. It's the same thing. It's the same thing. Just
perfect description.
Yeah,
Thank you.
just secured by real estate, which is so much better than the volatility. And the management fees in mutual funds are ridiculous. They're off the charts. There's in most recent years, there's been so many advocates and even the news, but advocates trying to tear apart or reveal the hidden fees that go behind mutual funds. And this is a much more alternative approach. It's a cleaner approach, and it's right there. You can actually physically touch it and see it, which is great.
That's a great analogy because here's the next layer or the attachment to that. A mutual fund is designed for passivity, right? It's a passive investment.
Right.
You put your money into that fund. You don't talk to the CEO of the companies. You don't look at their P&Ls on a weekly basis. You just put your money in and let it work across all those different companies. Well, it's the same thing for us in Freedom Venture Investments, right? In our real estate fund. Yeah. Because what we do is I'm thinking about the gentleman who commented on building large houses, in that Florida market. That's new construction. That's a build. That's management. That's making sure that all the subs show up on time every time. Architects, planning, city inspections, et cetera, et cetera. And we've done that. We've been there, we've done that. But again, to our point from the beginning, COVID has created a need for passive income for accredited investors to be able to get that mutual fund feel, right? That mutual fund feel with real estate. And I think I've said this before, and if I have, excuse me for repeating myself, but it's important. Commercial multifamily real estate has the same risk exposure as the bond market, right? Which is paying, 0.1% right now. Something ridiculous like that, right? Yeah. It's got the same risk exposure as the bond market, and yet it has the return profile of the stock market plus. Right? Plus. Yeah. If you go and do a 20-year look back in commercial real estate, multifamily, it has outperformed all other classes out there. That's very true. And watch, it's not a quick hit. It's not Bitcoin. Right. It's not penny stocks. Right. It's not those get in, get out, get paid in 30 days. Right. So it's, what it is, and I don't want to upset anyone, and if I do, tough. But you know what? It's mature investing. That's true. It's grown-up investing. Yeah. It's not Vegas rolling the dice investing. That's very true. Which is why we have to have a fiduciary responsibility as well. You should anyway. Yeah. But just had a call with my partners this morning, and there's a lot of capital coming in. It's beginning to roll. And there was one investor, excuse me, early 60s, mid 60s, and basically wanted to put everything that she had into the fund, everything liquid. And we're like, no, we got a fiduciary responsibility. Yeah. We know we can do great with it. Right. But, it's not right sometimes to take money. Sometimes it's okay to say no. Yeah. And we've been doing that recently, is turning money away because not turning investors away, but turning the capital contributions away or lowering the amount.
And I think, just to add to your point, I think what can happen, especially right now, a lot of people are in that state of fear. They're like, oh, let me just withdraw everything I have in the stock market out of my IRA, whatever it may be. And they're like, I got to give you and put it all somewhere. And no, having that responsibility is really important. Because sometimes people are transferring, their life savings or their retirement. And what's really important, especially, who knows what's going to happen in the next few weeks? Who knows what's going to happen in the next few weeks? Because
why you got to bring that up?
Well,
why you got to scratch that blue?
Well,
why?
Because it's true. When I look at a tax plan, and I don't care if you're blue or red at the moment, but the reality is, if you look at a tax plan that says we're going to tax even more. Currently, actually since November, it's coming up to a year, I've been living in a socialistic country, okay? I have dual citizenship and I'm living in a socialistic country. I can't tell you the damper, the unmotivated factor that's into play when more taxes are involved. Let me give you a very simple illustration, a real one. My buddy who owns this co-working space, if he wants to hire an employee and pay them a really decent salary, let's just say 2,000 euros a month. Let's say he wants to do that net take home and just have a really good income. In order for him to do that, it's going to cost him 4,000 euros as a business cost. That's not right. That's not right. So when I hear a tax plan that says 40%, 50%, 60% taxes, man, the only people that I would want managing funds is the people themselves. Like, you people should be responsible to, to have their own money to put it into the economy, not bureaucrats, not politicians. So I am all for a better tax savings plan. And I think the more money that people have in their pockets to make their buying decisions, the better. That's what I think. Very clear and simple.
Look, if you have a capital gains on the horizon, we'll say in the next 3 years, my recommendation is don't manifest that capital gains.
It's extended.
Let it ride.
Right.
Push it away.
Yeah.
Push it away.
Yeah.
And we've done a lot of work, Nathan, to set a foundation with our fund to answer as many of those fears as we possibly can.
Exactly.
Are we perfect? No. But have we brought some real intelligence to what we're doing? The answer to that is yes. So watch. Let's say it goes to a higher tax landscape, Q1, 2. It's going to take them a little while if the other guys get in, right?
Yeah.
And it goes to a more aggressive tax landscape for them. If the capital is in the fund prior to that, it's okay. Yeah. Because we've got a 5-6 year exit strategy.
Exactly.
And I promise you that the tax landscape 6 years from now will be a lot different than it is from today, or Q1, 2, or 3 of next year. So, wealthy people have hedged against inflation. They've hedged against political stupidity. They've hedged against ridiculous taxation. They've hedged against legal challenges. They've hedged against all of those big financial icebergs, if you will, that are out there by investing in multifamily real estate. And I'll say it again, if you are not the person who wants to do this yourself or has time to do it yourself, if you're not that person, then we can take care of you, right? We can take care of you.
Exactly.
We have the ability to passively invest and give our investors all, and I mean all of the, all of the ability.
The assurity. I look at it as assurity, like being assured that your money is getting put to work without the fear of it tanking or being lost. It's secured in the asset, and that's really important.
Yeah, for sure. For sure it is. Absolutely. So look, let's play out a couple of scenarios, Nate.
All right.
Let's play out, a blue and a red win. Okay. Now, here's the thing. Basically, the big picture that we always hear is the average American is, big government, small government, right?
Yeah.
Higher taxes, lower taxes, more socialistic, less socialistic. So how does that play out for us in our business model? And it's really simple. And again, without sounding corny with the win-win stuff, but watch. Let's say it stays Republican. It's business friendly, okay?
Right.
The SEC, I don't know if you have that link, but the SEC is doing everything they can to let people raise money, deregulate the raising of capital so that capital can get up, get out, and go to work. Because if capital does not work, our economy will die. All right, I'll say it again. If capital is not working at a high rate of speed, high yield, our economy will die. We will not limp through the next 15 years getting negative yields from T-bonds.
That's so true.
Your retirement sucks if that's your plan. You're done. It's all over. Forget about it. Go home. So the SEC says, all right, let's loosen up some of the rules and regulations, business friendly, okay? And we can get some momentum. So if that's the case, how does that look for us in multifamily investing? It looks great because we can project that people will have money available to them. Maybe their jobs are coming back. They're able to go to work and pay the first bill that they always want to pay, which is their mortgage and their rent.
It's very true.
Now, it's the other side of the equation. The other side of the equation is, trickle-down Reaganomics don't work, says the Democrats. Those big, bad, money makers who are just, for some reason, they still think that money and morality go side by side. And if that's the equation that somebody looks at, again, go home.
Yeah.
This isn't for you.
Right,
all right?
Right.
Just because somebody has money, has earned money, has put themselves in a position to create wealth, it doesn't mean they're bad people. Because here's the other side of the equation. If the Democratic thought process wins out and they tax the wealthy, they tax the corporations. If you earn over $100,000 a year, then we're going to tax you. Okay, we're coming for you. Now, if that's the case, there's less capital to work with in business. Okay, so there's less capital in business. Well, what does that mean? Well, guess what? It just means that the tax money is now going to go to social programs to pay rental vouchers and Section 8 and assist in housing, and we're just going to hand it out. I mean, look, no, that's very simplistic. And there's probably some people with a lot more economic intelligence than I do. But guess what? I don't care. It's fundamental.
It's true.
One way or another, I'm getting paid as a multifamily real estate investor. And here's what's important. If I'm getting paid, guess who else is getting paid? My investors.
Investors, yeah.
Investors. So, big picture, will it affect my four walls? My family? Maybe. But, I've been up and I've been down. You know what I mean? I've been on both sides of that equation. So I didn't mean to get kind of like soapboxy, but that's really how I look at it. I'm not entertaining the sky's falling, Chicken Little.
Right.
I'm entertaining opportunity is created when preparedness is representative. And when the opportunity shows up, we're going to be prepared to execute on it. I think that's the definition of luck. You know what I mean?
Yeah, absolutely.
I'm not lucky. I work hard.
Yeah.
So.
And I think people who genuinely care about the opportunity that's available. The fact that you have the opportunity to start a business, the opportunity to invest in real estate freely, the opportunity to, just commerce and access to capital can sometimes be looked, passively, and until it's taken away. Sure. Until it's taken away, you don't realize, it's like you don't realize how good you have it until you don't have it. So the reality is it can sometimes feel so good for so long until it's taken away. And then when it's taken away, it's just a mess. And the reality is right now, economically, when you look at what's going on for the past few years, it's hard. It's very difficult, not only in like reduction of gas prices, fuel prices going down, and many other economic indicators. Why not just keep it going up? I mean, why not?
So here's something that's interesting, right? Everybody has their core competency, right? We in business, we say, are you driving in your lane?
Right.
You put me in a social media development ad interaction lane, forget about it. You know how
to log into Facebook?
I'm amazed that I even get on Skype every week with you. I pat myself on the back of the head. But one of our team members is very closely aligned with a lot of high access traders. I'm going to leave it at that, right? Think of your JP Morgans, your Fidelities, your Edward Jones and that kind of thing.
Right.
And because the comment that seems to be out there consistently is, the stock market is kicking ass and taking names, right? Why do I want to diversify into an alternative investment like real estate when, I'm riding high. And there's a couple of things that I think are important. They were riding high during the dot-com age, right?
That's true.
They were riding high during the adjustable rate mortgage phase. And they've been riding high now on the tech bubble. Yeah. Right? They call them FANG.
The FANG.
F-A-N-G, right?
Yeah.
Your Facebook, your whatever the A stands for, whatever the N stands for, your Google, right?
Yeah.
Right? I don't know. I know that they're all tech. And these men and women who really do have an inside track, for want of a better term, are licking their chops right now because of the commission structure. But they know Nathan.
It's
they
coming.
know that none of it is built on fundamentals, on
Right.
transference of goods and services.
Right.
It's imaginary, dude.
Yeah.
It's imaginary.
Yeah, it's true. It's true.
It's
Can be
an imaginary investment.
hyperinflated valuations can really. I think we saw that really happen. And since we're talking about tech stocks or tech companies, an example, Tesla is a good example of that. Even though they're
I was just gonna say Tesla, dude.
Yeah,
Tesla's at like 800, and the real economists say it should be at 50.
Yeah, I mean, the reality is that they just came out of a big hyper valuation, going over 2,000, I think it was over 1,500 per share just a few months ago until the stock split. But that kind of thing, there can always be a lot of positivity. But again, that whole drawback, the whole like, whoa, we just sunk right down. I mean, you're not going to get that kind of volatility in multifamily investing. You're not going to get that in real estate. That's the good thing, right? That's the good thing.
My point again talks about the maturity of investing.
The maturity of investing, yeah.
I want to ask anybody out there who listens to our show, did they invest in Quibi? And how did that work out for you? Right? Did you see that? Is it Quibi?
Listen. It's so funny you bring that up. No. But it's funny you bring that up because when I saw Quibi and I saw what was going on, I'm like, wait a second. How is this going to last? The competition. And I knew Apple is about to release
$2
billion. Exactly. It's just, and I know that I pay attention to those kinds of things, and I'm like, this is insane. Like this is not going to go very far. Just on the premise of what they're doing, and I'm not surprised they went out of business that fast. I actually thought they were going to sell, but I'm not surprised they went out of business that fast.
Well, it was months.
It was 6 months. It was 6 months.
And I started looking into it a little bit. Again, bringing my high level of economic understanding.
Yeah.
But it's like, if you look behind the curtain and there's nothing there, then who's that on, man?
Right.
Is that on them, or is that on the ignorance and the hype of the investor?
Right.
You know what I'm saying?
Yeah.
What would it be like to have to call your investors and say, guys, I'm sorry. I'm so sorry. I know you gave me $2 billion, but I kind of screwed up.
I know.
You know what I mean?
Horrible.
It's all gone. There's nothing there. Nothing there.
It's horrible.
Let me tell you something. If we can get to those investors who invested $2 billion, they want to kind of like
make
an investment like that with us.
Come on over.
I got you covered, because this is important. I say it in a humorous manner, but when you pull back the curtain, guess what? There's sticks and bricks there.
Exactly.
There's real estate.
Exactly.
Real estate has never pulled a Quibi.
Yeah.
All right. It has never pulled a Quibi. Real estate has never gone to freaking zero.
I can see that the title of next week's show is like, you will not have a Quibi. No Quibis allowed.
I'm not to have a Quibi. No Quibi here. All right. No Quibi. No Enron. No Quibi.
Shoot.
Right. No. I nearly swore right now. Oh man. I tell you, dude, that's how I look at it.
Yeah.
That's how I look at it. So fundamentals. Do me a favor.
Yes.
I want to throw a little shout out there to my accredited investors here on the North Shore in Massachusetts.
Yes.
You got a link there. Can you throw it up?
It's up already. I'm already there.
Okay, awesome. So, guys, if you go to that link, info.freedomventure.com/Palana. We are doing the investor luncheon there. It's a beautiful steakhouse. Steak, fish, chicken. There's like 3 choices. Lunch is on me. It is a very, very small group, and it's kind of interesting. I'm going to be direct. I was very confident that this thing would have been filled out last week, but what I'm beginning to see in some of our commentary is a lot of people want to come, but they're still riddled with fear over COVID.
Over COVID, yeah.
It's like, so listen to me. This is a COVID-compliant environment. Spacing, masks, cleanliness, et cetera, et cetera. We do these cash flow shows. I do webinars. I'm on 4 or 5 podcasts a week. We're teaching. Money's coming in, but I miss people, man. I miss people.
Yeah.
I want to interact.
It's so true.
I want to share what we're doing with the right investors. I just got a notification from Eric, one of our team members. No, I just brought a new investor in. It just gave me a little note popped up. So, I know folks are coming in. They're reaping the rewards of what we do at Freedom Venture Investments. But take a look at that link if you're on the North Shore. You will need to register for that. There is no charge. Actually, I'm buying you lunch. It says from 12 to 3. I'm pretty confident we'll be out earlier than that, depending on how the questions go at the end of the presentation. Not a sales pitch. It's not for everybody. We turn away some investors because it's not right for them. But if you want to spend some time with us on November the 7th, click that link or visit that link, however Nate set it up, and we'll look forward to seeing you on November the 7th. And finally, don't forget, 104.9 FM this Saturday is the launch.
Nice.
The launch, Nathan.
Nice.
Of Real Estate Revealed with your host, Dave Seymour.
Dave Seymour?
The Dave
Like
Seymour.
the guy from on TV A&E for Boston.
Yeah, that guy. And CEO of Freedom Venture Investments.
Oh my goodness!
We're doing a radio show. We
That's awesome.
We do record on Wednesdays and it plays on Saturdays. But once we get through the first 3, 4, 5 episodes,
that's like how we do it here. That's how we do it here. We recorded this last Sunday, and now it's what's it
last Sunday?
Friday? Yeah.
How did we know that there was going to be such an incredible debate last Sunday? It was, I don't know. But check out the radio show, 104.9 FM. Right here on the North Shore in Boston. So, yeah, dude, that's what I got.
Stuff.
What are you dancing for?
I got the music's on. The music's on.
This is music playing.
It's over here on the production side. I got the music going.
So people can't hear me when the music's going.
No, they can't. It's just like soft. It's like elevator music. It's like
really?
Elevator.
Nice.
Yeah, it's like elevator music. And next week, tune in because we are going to have some special sound effects next week. so for everybody, for everybody, thanks for everybody for tuning.
Hold on a minute. Hold on. Can we bring in a guest on the show?
We can bring in a guest. Who are we going to bring? Is it going to be a surprise?
I don't know. I'll find one. There's a guy outside. He's got something to say.
All right. Thanks so much, everybody, for joining in to another episode of the Cash Flow Show. Dave, if you dance at the same time as me, it will make it sound like. We'll see you next week. Same time, same place. Thanks so much for tuning in. Take care. Have a great weekend.